Wall Street recently slapped a $250 billion price tag on an artificial intelligence lab called xAI. This is a company burning through more than $1 billion a month, a company where all 11 original elite co-founders walked out the door, and a company that had to be completely rebuilt. This visual comparison exposes the gap. Anthropic reportedly generates over $30 billion annually to support its $400 billion valuation. Meanwhile, xAI estimates a mere $1 billion in revenue, yet commands $250 billion. It operates like a budget airline, but prices itself like a private jet. Across the broader economic landscape, 95% of companies are realizing zero actual return on generative AI. Yet investors continue pouring in capital as if gravity no longer applies to the market. To the average retail investor, this constant upward momentum looks like the natural result of a booming, diversified economy holding up the traditional financial system. The market has transitioned into a mass hallucination, a transfer of wealth operating under the guise of technological innovation. It has become a trillion-dollar casino. This S&P 500 pie chart reveals a market being held up by a concentrated cartel of tech whales known as the Magnificent Seven. These 7 companies now consume roughly 36% of the entire index. Through the first 3 quarters of 2025, they accounted for over 41% of total returns. Zooming in on the valuation multiples reveals how far they have detached from reality. Alphabet and Meta trade around 28 times earnings. Amazon hits 35, Apple 37, and Nvidia sits at 50 times earnings. Moving further out on the risk curve, the math breaks the scale entirely. Palantir sits at 400 times earnings, and Datadog commands an astonishing 430 times earnings. The logical foundation of cash flows, discount rates, and balance sheets has been discarded. Wall Street has stopped pricing assets based on intrinsic value. They are pricing them based purely on attention, effectively pre-ordering hope. If these valuations ignore economic reality, what exact mechanism is continuously pumping capital into them? The engine driving this fire is the systemic rise of passive investing. Today, 63% of all U.S. stock funds are held by passive indexers. That amounts to more than $13 trillion in the market. This flowchart demonstrates the mechanics of a market cap-weighted index fund. The rules are rigid. The bigger a tech company gets, the more of it the algorithms are forced to buy. It creates a massive automated feedback loop of forced liquidity. As the cycle spins faster, this $13 trillion pool of blind money bypasses earnings reports, economic data, and fair valuations. It buys indiscriminately. To justify this blind momentum, Wall Street sells a specific narrative. They insist that behavioral finance and algorithms have replaced traditional analysis, and that AI has rewritten the math of the market forever. We saw this exact same blind optimism during the post-war economic high of the early 1970s. Factories were booming, and a cluster of supposedly invincible corporations emerged, known as the Nifty 50. At their peak, these megacorporations reached a nearly identical 45% market concentration. While the broader market traded at 15 times earnings, tech darlings like Polaroid traded at an absurd 90 times earnings. Then, in 1973, the macroeconomic dominoes began to fall. Inflation surged over 11%, and unemployment doubled to 9%. Finally, oil prices quadrupled. The economic music stopped entirely. Those invincible stocks were obliterated. The broader market plunged 50%. Polaroid lost more than 90% of its value, dragging Wall Street into an 8-year recovery just to reach its previous highs. This side-by-side comparison reveals the pattern. The market concentration, the massive valuation multiples, and the blind public optimism are structurally identical. The Magnificent Seven are simply a modern echo of the Nifty 50. Unlike the gradual decline of the 1970s, today's top-heavy indices are built to crash at light speed because of the automated structures managing them. In this visual model, a 10% pullback in a massive AI stock like Nvidia does not stay isolated. It bleeds directly into the Nasdaq and the S&P 500. When support lines break, massive commodity trading advisors running rules-based models instantly flip their exposure from long to short. They do not hold meetings to discuss company fundamentals. This rapid price drop forces options dealers into a negative gamma regime. To hedge their own books, they must aggressively sell the underlying stock, compounding the downward momentum. The liquidity crunch becomes instantaneous. The same $13 trillion of passive index money that was mathematically forced to buy the top is now mathematically forced to sell on the way down. The economist John Maynard Keynes famously noted that markets can remain irrational longer than you can remain solvent. Beyond the CEO tweets and skyrocketing charts, the smart money recognizes this as a massive experiment in the greater fool theory. They are betting on the hope that someone else will pay a higher price for the same hype tomorrow. When the bubble inevitably bursts, the insiders and institutional whales will not stick around to watch valuations violently compress. They will quietly sweep their chips off the table and rush for the exits, which leaves a chilling question. When the smartest guys in the room run, who exactly do you think they are selling to? It is the everyday retail investors, the passive indexers, and the millions of people whose retirement accounts are quietly acting as exit liquidity in a $1 trillion casino.